All right, good morning, everyone. Let's do a quick sound check. Let me know if you can hear me. I got Carl, Craig, David, Eddie, Eugene, Malik, Peter, two Peters, Rob, and so on. Satish, Suleiman, Steve. All right, everybody. So this is a live webinar. If you have any questions, I encourage everyone to jump in and ask and try to understand a little bit about what I'm going to teach you today with price action, some tips on trading as well. Before we begin, remember that trading is risky. Please don't trade with funds you cannot afford to lose, and talk to your broker. Just understand there are risks involved with trading. The next thing I want to discuss is what we have available for those of you who may be new to Day Trade to Win. We have a few downloads, a few things that you may want to be interested in when it comes to learning and starting to day trade. Some of you may already know this and have this, but you can see here, if you come to the Get Started guide and look at getting started how to trade, you can download this free guide on how to start day trading. You can download NinjaTrader, including live data. That way you can practice and understand a little bit about trading and just get involved a little bit. We also have a how-to setup and info, and this is a great place if you're looking to learn a little bit more about how to roll over contracts, how to optimize your trading computer, how to link your charts, how to open charts, how to add a data feed. So this specific page has a lot of information that will teach you about NinjaTrader and how to do things, trading the micro E-minis, for example, market replay. So this is a good reference, a good resource to have. Now, when you come over here to courses and software, we do have here an area called free stuff and downloads. And you come to this downloads page here, you have a couple of options. One of the main options here is the news indicator for NinjaTrader 8. This is a 6-month license to get the news indicator so you could get the actual news alerts on the chart itself. So I think this is a very, very good way to know when news is going to occur. But if you don't want to use that, you can also go to the online news calendar. We have an online news calendar, which is a website that we link that has the same information. So really you don't need the news indicator if you are looking at a news calendar. It's the same thing. All right. So check out the free downloads here on this page, and then you have here the Atlas Line page. You can learn about the Atlas Line. We have the Trade Scalper page to learn about the Trade Scalper. We have the At the Open method to learn about the At the Open method, and so on. And we have also on the videos page lots of videos here, not just trading videos. I don't know how many hundreds of videos we have here, but we also have the testimonials as well. So those of you who are looking at getting into trading and seeing if Day Trade to Win is right for you, you have a lot of information on daytradetowin.com, and there's also a blog where we put our latest videos, tips, and information on the blog as well. All right. So to begin, let's start off here with looking at a 1-minute chart. I'm going to try to keep this webinar simple. If you have questions, again, this is a live webinar, so I'm able to take questions from anyone. What you see here is a 1-minute chart. I'm using the E-mini S&P. I happen to have the Trade Scalper software on the chart. I like to always tell my traders not to start trading the first few minutes of the day because there's a lot of volatility. As soon as the market opens here at 9:30, you can see that the average true range, the ATR, because these candles are getting so big, just jumps up here. So as a good tip, a good reference, it's not a good idea to trade just as the market opens. Give it a good 5-10 minutes. Just let every buyer and seller get out of the way with the influx of trades that are now trying to compete against one another. Never a good idea to jump in right as the market opens. And this is the same idea as well if you're looking at the London Open, which is 3 o'clock Eastern time currently, which is 8 o'clock London time. It's the Life Exchange Open. If you're looking to trade overnight, the same thing. You don't want to trade right as that session opens because there's a lot of activity, and usually there are big swings as well. I would say, Jason, 10 minutes is more than enough. 10 minutes, just as long as you see that everything kind of calms down a little bit, because you could see these drastic moves that occur that are out of your control. So yes, that's what I would say. About 10 minutes. is a good starting point. Now, the other thing you want to look at here, those of you who probably watched that workshop that I have on Day Trade to Win, there's a pop-up that occurs. You can go ahead and type in your email and your name, and you get this workshop that I created on looking at the ATR, and probably most of you have already seen it, but we can see here that the ATR is currently at about 3 points on the E-mini, now about 2 3/4 of a point, between 3 and 2.5 points. So this tells me that any candle that moving from this point forward, either up or down, should equal this value. So that means stops have to be understood when it comes to that. Your targets have to be understood as well. You can't look at a 10-point target when the market can only make about 2 3/4 of a point or 3 points right now. So you have to understand that the conditions are always changing with the market, but we have the ATR to help us understand at the moment if you're going to buy or if you're going to sell, what should be my target and how small or how large should the stops be. And that's important, because if you have a stop that's too small, you're going to get stopped out. If you have a stop that's too big, it's too much of a risk. You're not really doing yourself much good with having these large losses unnecessarily. So look at the ATR to kind of guide you. And even if the market's too slow or too volatile, you can stay out of the market as well. These entries, Neil, are the Trade Scalper. The Trade Scalper software right here is proprietary software from Day Trade to Win. And here is the Trade Scalper software right here. And basically, when you download the Trade Scalper software, you have options to show this double wick entry, show the first trade. You can have a sound file, which I don't have right now. You can have like doorbell sound as well. You can have a filter if the market's too slow. You can omit trades. So this is pretty intuitive. There's no optimization as well, which is nice. And this is the Trade Scalper software that you're seeing here on the chart. And if you want to go all right, sounds good, Jason. And if you want to go and you see, just overnight or pre-market, here are the signals that occurred. And obviously, I have to say that not every signal you're going to expect to be a winning trade, but at least you have an opportunity to take a break-even trade or a small win or a small loss. And one of the things that I do mention when it comes to trading price action, which is this webinar is about, is looking at price action, focusing on more time and the candles, right? Time and price are very important. So if this trade, for example, if you took this trade and it didn't make a result or didn't make a target and it just kind of went sideways, I think the longer you're in a trade, the worse off you are. So consider that as a part of price action, time. The longer you're in a trade, the worse off it is as well. So I want to emphasize that because that's important. We want to make sure that everybody is in and out of a trade in fairly a sooner rather than later moment, right? So let's take a look here while the market is opening. So here's another example. And this example here I think is a good one to understand why we need to know what the stops are. So if you take a look at this example here, just as an indication, you see how this signal, after this signal occurred, the market, the very next candle turned around and went up, okay? So if you have a stop that's so tight, let's say just a couple of ticks here, you can see that the market will stop you out just on random movement. But if you look at the ATR being here about 1.5 1.25, your stop needs to be at minimum a little bit larger than what you're seeing here. So I'm not saying risk 5 points, but definitely if you're going to look at this trade and have probably a 2 points or 3 point stop, at least enough to keep you in the trade. And so that way, when the market does reverse or go against you and then continues lower, you're not going to get stopped out prematurely. So the idea of looking at these candles and understanding what the market is currently doing, it allows me to say, what should my stop be? What should my target be? Now, again, I don't know that all this here is going to happen. So I'm going to show you today a way to trail a stop. This is something I teach in the classes. That way you can have an understanding of trailing stops, which after the trade goes in your favor, why not take a little bit more as well? Okay. Mike, can you see that? Mike, are you able to see my chart there? You may want to exit the room and come back in. There are a lot of people in the room, but there's still room. I think the room is good up to 1,000 or so, but there are a lot of people in the room. So just exit and come back in. You should be able to see my chart. Maybe it froze. All right, so now as I go forward here in time, let me just go to see what the current conditions are doing. Nothing. All right, so let me show you a little bit about trailing stops. All right, so trailing stops are based on the market beginning some move, whether long or short, and then continuing. And when you see the market go in your favor, yes, 1 times the ATR or this specific target is your best chance to get in and to get out. So when you see this opportunity of 3 points and the market continues, let me show you what to do. When the market goes in your favor, I'm going to go here into the future, and let's say I'm going to use numbers that everybody can understand. So let's say that it happens to be 41.56 as a buy. Okay, so if you enter here with one contract at 41.56 and you expect the market to move higher, at some point you want to begin to trail a stop. But the problem is, if the market goes against you here, you have to have some stop here in place that will protect you in case it doesn't go in your favor. And so as the market is starting to go higher and higher, you're always behind the market with some type of trailing stop. Now that works pretty good, but it doesn't work as well. Let me just change the line here to a little different color. Use that. It doesn't work as well when you use one contract as opposed to when you use at least 2 contracts or multiples of 2. So instead of just using one contract to buy and then trail a stop, and then you're trying to trail it behind it as it starts to go higher and higher, when you use 2 contracts here, so we'll say 2 contracts, when you use 2 contracts, what happens is you're protecting yourself as soon as the market goes in your favor, and I like to use, again, 1 times the ATR. So let's say, for example, the ATR is 2 points. Just giving you kind of here an example, ATR 2 points. If the ATR is at 2 points and the market moves to 41.58, which is right here, 41.58, right here, what happens is these 2 contracts that you currently are holding, multiples of 2, so 2, 4, 6, 8, exit half of your position. So take half off. So exit half of your position at 1 times the ATR. So at 41.58, which again is 1 times the ATR, because remember we're using 2 points as the ATR, take half off, and obviously you're left with 1, right? So whatever your stop happens to be, if your stop, it's down here, or here, or here, whatever your stop happens to be, at this point, you are in the best position as a trader that you could ever be. And you could use this on stocks or futures or currencies. It doesn't matter. I'm using, obviously, a small 1-minute chart if you're thinking about scalping and then continuing on and holding on to the trade for more profit. But what I'm showing you here is universal. It can be used on anything. So as soon as you make 1 times the ATR, take half off of your position. Again, we're considering this at being 2 points. And the stop is going to be placed exactly the same as the profit that you made. So if you made 2 points, you place your stop and move your stop 2 points in the opposite direction, which would be 41.54. This is now your new stop, 41.54, which really does create a break-even trade, except for commissions, right? You may have to pay for commissions in case the market goes and turns around. But so what? If the market does turn around and stops you out, you made 2 points on half of your position, you lost 2 points on the other half of your position. This becomes a true $0 trade. And to me, this is the best way that you could manage a trailing stop, because you have nothing to lose. As soon as the market makes some type of profit, your new stop is now placed exactly at the same amount on the opposite side of the profit you made. So you made 2 points, you lost 2 points. Now, the idea isn't for this to occur. The idea is for the market then to continue another 2 points, which would now make it 2 times the ATR. If it moves 2 times the ATR, which is 4160 right over here, at this point, you can then move your stop up, right? You're exactly the same distance behind the market. So this is your distance. If the market makes another 2 points up, you move your stop up. So this is the distance that you're now trailing the market. If it continues 3 times the ATR, right? Again, we're using the 2 points, right? Not the current ATR that's being shown, but we're using 2 points as the example to make the math easy. 3 times ATR. Then it would be 4162. And at 4162, when this occurs, you bring your, oops, trying to move this box here. You bring this up again. And now we have, again, you bring your stop up. So in this fashion, because you already made a profit target and you're using the stop to finalize where you want to get out without losing your shirt, this is the best way that I know to trail a stop. Now, some days, good question. So Jason has here, I'll get to that question in just a second. I'm going to forward it to everybody. Jason says, why not just put it at break even to lock in profits? I'm going to explain to you why in a minute. So what happens here is that the days that we have that trail or that are trending days aren't quite that often, right? So we have days that are more whipsaw and choppy. So we can't say that trailing a stop every single day is the way to be a trader, because we know that many times it's better to get in and get out, and then get in and get out, and get in and get out. So this is 3 successful trades, as opposed to getting in, trailing a stop, getting stopped out at break even, and then getting in again, making some profit, and then getting stopped out at break even. So the idea isn't to have a trailing stop on every single trade that you take. The idea is to say the type of day that exists, because it's volatile, because yesterday was a trending day, because the market is moving very strong in one direction or another, that's when we have the ability to trail a stop. So I don't want you to think about trailing stops as every day that's what we do. Typically, trailing stops, or days that trend, really, that's what we want, a day that trends, only occur when the market is more volatile. It doesn't happen when the market is slow. So if you see a slow day where the ATR is at 2 or 1, 1 point, relative, right? Relative to the market, 1 point, 4 ticks, 8 ticks, it's not a trending day. But days that are strong are usually strong trending days. You can do this method. Now back to Jason's question. Why not bring a stop to break even to lock in the profits? So great question. Let me show you why. So if you have, I'm going to just move this here into the future. If you enter here at 4156 and your target is 4158, the first target, I should say, right? And then we see the ATR again at 2 points, right? So if you wanted to take the first target here at 4158 and bring your stop, right? So let's say your stop is here to here, right? So are we on the same page, Jason, so far, right? So it made 1 times the ATR, right? And you say, well, why am I bringing my stop equal to the 2 points I made? Why not just bring it here? Great question. If I know that the average true range is already 2 points, right? If I know that it's 2 points already, that means that once the market reaches 41.58, the possibility of it going 2 points in the opposite direction exists. Usually the market doesn't go straight up, right? The market does this, or it should say it doesn't go and continue in the same direction, right, immediately. What usually happens is that it goes this and this and this and this and this, right, like that. So if I already know that the ATR is 2 points, as an example, and there's a possibility of the market moving the same 2 points in the opposite direction, what's going to happen, and what happens to a lot of traders, is they get stopped out prematurely just on random movement, because this, the 2 points in the ATR, already indicates that the market could move up 2 points just like it could move down 2 points. So once you make that first target, if you do bring your stop up to break even because you want to lock in half of your profits, many times it goes down, right? Because I already see this as 2 points. It'll go down, it'll stop you out, and then it'll continue higher. Yes, you made half your position, you made some money, but that's not the goal of the trailing stop. The goal of the trailing stop is to say, once it makes half or 1 times the ATR half your position, let me try to go for 2 or 3 times the ATR. And if I know that the market could go and move this amount of distance and take me out, it's not going to help me. It's every single trade is most likely always going to be just half of your position and then stopped out. So this, what you're suggesting is an idea to lock in profits so tight that you won't give it a chance to breathe. And we have to give it a chance to breathe, because this tells me just like it moved up 2 points, it could easily go down 2 points, and that's the problem. So Jason, let me know if you understand that. Okay. I wish I could do that, actually, Jason. I wish I could say, you know, that lock it in as tight as possible. And I also wish that it could just go straight up, right, and just go 2, 3 times the ATR. But, you know, sometimes the market doesn't do that the way that we want, right? Instead, what happens many times is the market flip-flops, goes up and down. We have to give it some breathing room. Right? Now, if instead, if you say, well, the market's normal, it's, you know, whipsawing and making these moves up and down, even if you take 2 or 3 contracts and you want to get fully out, just get fully out. You know, just take your money and run, and then look for the next trade. I mean, scalping, there's so many trades that you can take that we really should pick and choose the best ones. So trailing stop can be used on the Atlas line, on the at the open method, on your own trading, even the trades that we teach with the roadmap and everything else in mentorship. We have this idea, taking 1 times the ATR, at least a small target, is great. But if there's an ability to take more, let's try for that as well. If you're new to day trading and want to learn more on the benefits of trading the markets, visit daytradetowin.com, join the next mentorship class starting later this month, and subscribe to the Day Trade to Win YouTube channel. We focus on price action and work exclusively with new and beginner traders who want to learn more on how to prosper from trading.